Every central bank on Earth tells the same story: stability, safety, order. They promise to smooth out crises, tame inflation, and protect the economy from chaos. On the surface, it sounds like a neutral, technical mission, but the birth of the most powerful central bank in the world, the Federal Reserve, didn't happen in the clean light of open debate. It was born in fear, in panic, in backroom deals, secret meetings, and quiet negotiations between men who controlled more money than some governments. The Federal Reserve did not appear because the system suddenly became wise. It appeared because the system was scared. Before the Fed existed, American money was a fragile arrangement held together by habit and hope. In the late 1800s and early 1900s, the United States had no permanent central bank. Instead, there was a tangled web of thousands of private banks scattered across the country. Each one issued its own promises, its own deposits, its own notes. Some were solid, others were little more than confidence tricks wrapped in marble buildings. The government had experimented with national banks before. The first and second banks of the United States had both acted like early central banks, but political backlash killed them off. Americans distrusted concentrated financial power. So the country drifted into a compromise. A national currency, yes, but no single institution with the authority to flood the system with liquidity in an emergency. There was no lender of last resort, no central authority that could step in when fear moved faster than information. Under that kind of system, every rumor had teeth. If enough depositors believed a bank might be in trouble, they would rush to withdraw their money. If a few banks fell, confidence would crack elsewhere. One failure could pull others down with it, like a row of dominoes. From the outside, the economy looked vibrant and dynamic. Underneath it was dry timber stacked in the sun, waiting for a spark. The spark came in 1907. In October of that year, a speculative scheme in New York went bad. A group of financiers tried to corner the stock of a single company and failed. On its face, it was a private gamble gone wrong. But in a world built on leverage and trust, the consequences spread quickly. One of the firms connected to the scheme was the Knickerbocker Trust Company, one of the largest financial institutions in New York. Whispers began. Knickerbocker might not be able to meet its obligations. Maybe it had been reckless. Maybe it was insolvent. Maybe depositors wouldn't get their money back. In an era without deposit insurance, that kind of rumor was enough to cause a stampede. Clients lined up outside Knickerbocker's doors demanding their cash. The tellers paid out until they could not. Once the trust stopped honoring withdrawals, the panic fully ignited. If Knickerbocker could fall, what about the others? Fear leapt from building to building, street to street, city to city. Other trust companies saw their own depositors rushing in, desperate to get out before the doors closed. The stock market plunged. Banks began hoarding what little cash they had. Call loans to brokers were retracted. Businesses that had never heard of the failed speculation suddenly couldn't make payroll because their credit lines evaporated overnight. The crisis became systemic, not because of one company's mistake, but because there was no institution powerful enough and trusted enough to stop the fear. There was no Federal Reserve to step in. So the job fell to a single man. J.P. Morgan was not a president, not a Treasury Secretary, not an elected official of any kind. He was a private banker whose influence reached across railroads, steel companies, and banks. In 1907, he effectively became the central bank of the United States by force of reputation and will. As panic spread, Morgan summoned the leading financiers of New York to his home and to his private library. He examined balance sheets late into the night, sorting institutions into categories: those that could be saved, those that could not, and those that might drag others down if allowed to fail. He pressured strong banks to lend to weaker ones. He convinced some firms to merge, others to accept rescue on harsh terms. When trust companies faced collapse, he forced the city's banks to provide emergency support. When the stock exchange itself was on the verge of shutting down, he organized a pool of capital to keep it open. It was triage, not democracy. A private committee of millionaires was deciding which companies lived and which died, which depositors were made whole and which were ruined. Eventually, the panic subsided, markets stabilized, the system survived. But the lesson that lingered was unsettling. The stability of the American financial system depended not on law, not on a public institution, but on the judgment and health of one aging banker. He was already in his 70s. He would not live forever. The next time panic hit, there might be no one with his authority to step forward. That realization echoed from Wall Street to Washington. Something had to change. In the Capitol, politicians recognized that the crisis had handed them a rare combination: public fear and a clear villain. The Money Trust, a small circle of powerful bankers, was blamed for controlling credit, manipulating markets, and endangering the economy. Newspapers raged, cartoons mocked, committees formed. Hearings were held not only to uncover facts, but to show angry citizens that someone was being held accountable. Out of this moment emerged Senator Nelson Aldrich, one of the most influential politicians on financial matters. Aldrich understood exactly how dependent the system had become on private coordination. He also understood what bankers wanted: A more elastic currency, a way to expand and contract the money supply as needed, and a mechanism to manage panics without relying on one person's library. So Aldrich proposed a National Monetary Commission. The commission would study foreign central banks, the Bank of England, the Bank of France, the Reichsbank in Germany, and learn how the old world handled banking crises. It was presented as a sober, scientific mission, modernize American finance by following the best practices of Europe. But research trips and official reports were only one part of the story. The true design of America's new central institution would be drafted in near secrecy. In November 1910, a small group of powerful men boarded a private rail car in New Jersey. They traveled under assumed names. Reporters weren't invited. Even the servants on the train were kept unaware of their passengers' identities. The destination was Jekyll Island, a private retreat off the coast of Georgia, owned by a wealthy club of industrialists and financiers. There, in a secluded clubhouse surrounded by marsh and pine, this group set out to redesign the architecture of American money. Around the table sat a senator, leading Wall Street bankers, and financial experts closely linked to the largest institutions in the country. They debated structure, control, and power. How could a central bank be created in a nation that hated the idea of centralized financial authority? How could they coordinate, credit, and stabilize banks while convincing the public this new institution would protect ordinary people, not just the elite? The word central bank itself was treated like poison. Americans associated it with monopoly, corruption, and foreign influence. So the group chose a different label. They would not call their creation a central bank. They would call it a reserve system. The plan that emerged, the Aldrich Plan, proposed a network of regional reserve banks, loosely spread across the country, overseen by a central body. It was a clever design. On paper, it looked decentralized, with branches in different cities. In practice, the key power to issue currency, rediscount loans, and coordinate policy would still gravitate toward a central board. The system would provide an elastic currency, meaning the money supply could be expanded during crises and contracted when things calmed down. It would serve as a lender of last resort, stepping in when private banks were short of cash. It would coordinate the reserves of the banking system, something individual banks had failed to manage on their own. Panic had created the demand. Now a blueprint existed to meet it. When the Aldrich Plan was brought into the open, reactions divided sharply. Bankers praised it as modern and efficient. Many progressives and populists saw something very different, a sophisticated attempt by the money trust to formalize its control under a new name. To them, the plan placed too much power in private hands and too little under public oversight. Public distrust mattered. The memory of 1907 was still fresh, and suspicion of Wall Street ran deep, so opponents hammered at the plan, calling it a banker's government in disguise. The name Aldrich became a liability. It symbolized the very alliance between politics and finance that many Americans feared. The proposal had to evolve or die. New political figures stepped in, including Congressman Carter Glass and others aligned with the Democratic Party. They reworked the language, adjusted the structure, and shifted the balance, at least on paper, toward more visible government control. Regional reserve banks remained, but the central board in Washington would be more directly connected to the federal government and the president. The result of these negotiations and compromises was the Federal Reserve Act of 1913. To the average citizen, it sounded like a wise middle ground. There would be 12 regional Federal Reserve banks, giving the appearance of geographic balance and local input. There would be a Federal Reserve Board in Washington, with members appointed by the President and confirmed by the Senate, giving the appearance of democratic oversight. The system would issue a new form of currency, Federal Reserve notes, backed not only by gold but by the assets and credit of the banking system. The stated mission was simple and reassuring: provide an elastic currency, serve as a lender of last resort, and promote financial stability. Behind those phrases, something profound had changed. For the first time in American history, the power to expand and contract the nation's money, to decide which institutions received emergency support, and to influence interest rates on a national scale was concentrated in a semi-public, semi-private entity, designed to be insulated from direct day-to-day political pressure. It was close enough to government to claim legitimacy, yet distant enough to operate with a large degree of independence. Panic had justified the need. Politics had shaped the story. Power had quietly moved. The timing of this transformation was not accidental. Barely a year after the Federal Reserve Act passed, Europe plunged into World War I. Even before the United States entered the war, the global financial system shook. Gold flows reversed. International credit lines snapped. Markets reeled. When America finally joined the conflict, the new Federal Reserve played a central role in financing the war effort. It supported the market for government bonds, absorbed shocks, and helped ensure that the Treasury could borrow the vast sums required. A tool created to prevent panic was now also a tool to mobilize national resources on an unprecedented scale. Once a central bank exists, crises do not disappear. They are managed differently. In the 1920s, the Federal Reserve presided over an era of rapid credit expansion, speculation, and apparent prosperity. Then came the crash of 1929 and the Great Depression. Scholars still debate how much the Fed's actions contributed to the disaster or failed to prevent its worst effects. Some argue it tightened at the wrong moment. Others say it did too little, too late. What is clear is that the existence of a central bank did not end the cycle of boom and bust. Throughout the 20th century, the same pattern repeated in new forms. Recessions, wars, inflationary surges, asset bubbles, and bank failures continued. Each time, the Federal Reserve was at the center of the response, cutting rates, raising rates, creating programs, buying assets, extending emergency loans. Each time, its decisions helped determine who bore the pain and who emerged stronger. In 2008, echoes of 1907 could be heard again. Instead of trust companies in New York, it was investment banks and complex financial products tied to housing. Instead of people lining up outside marble lobbies, panic moved along fiber optic cables and trading screens. But underneath the technology, the mechanism was familiar. Fear of insolvency, collapsing trust, liquidity evaporating. This time, it wasn't J.P. Morgan locking bankers in his library. It was the Federal Reserve creating lending facilities, rescuing some institutions, letting others collapse, and expanding its balance sheet by astronomical amounts. The faces had changed. The building had changed. The pattern had not. Panic exposes the weakness of the system. Politics rushes to the microphones, promising reforms. Power, often quietly, expands its reach. The birth of the Fed is one of the clearest examples of that cycle in motion. A crisis terrified the country. A small group of well-connected men drafted a plan in private. The plan was reshaped through political struggle and sold as modern, scientific, and necessary. And a new center of gravity was created at the heart of American finance. What does this history mean in practical terms? It means that phrases like financial stability and lender of last resort are never neutral. They describe real functions, but they also mask real choices. When a central bank decides which banks qualify for emergency support, which assets it will buy, what collateral it will accept, and how cheap it will make money, it is deciding in part who is saved and who is sacrificed. It means that whenever shock and fear ripple through markets, the same forces reappear. Panic unlocks political will. Political will creates new tools. New tools shift the balance of power a little more, often in ways that become permanent long after the immediate crisis fades from memory. The story of the Federal Reserve is not just about technical policy. It is about how fear can be converted into structure, how a moment of chaos can be transformed into a lasting institution, and how that institution can then shape decades of economic life in ways few voters fully understand. The names change, the laws change, the acronyms change, but the deeper pattern, panic, politics, power, keeps resurfacing. The next time headlines scream about an emergency rate cut, a liquidity program, or extraordinary measures, it will not just be a story about numbers on a screen. It will be another chapter in the same long narrative that began with bank runs, secret train rides, and meetings behind closed doors. Understanding how the Fed was born doesn't require romanticizing the past or demonizing the present. It simply means seeing clearly that the institutions which claim to manage risk and provide stability were themselves born from risk and instability. They are not outside the system. They are the system. When fear returns, as it always does, there will be calls for new safeguards, new programs, new authorities. The language will sound modern. The logic will feel urgent. The underlying motion will be familiar. Panic, politics, power. If this history gives a new way to see the world, treat it as a reminder that the architecture of money is never accidental. It is designed, redesigned, and reinforced in moments when most people are too worried about survival to notice who is quietly rewriting the rules. History has the answers, if attention is sharp enough to see the pattern repeating.